Welcome back to Talk Tickers. This is the deep dive where we take the stack of earnings transcripts, the analyst notes, all the financial models, and we strip away the PR fluff.
Yeah.
We skip the safe harbor statements, and we hunt for the alpha. I'm your host, and today...
Wow. Today is a massive one. We are breaking down a call that I honestly think business schools are going to be studying like 10 years from now.
It is Thursday, January 29th, 2026. And, calling what we just heard a quarterly update feels like a massive understatement. It felt more like a manifesto.
It did. It really felt like a relaunch of the entire company.
Exactly. Tesla has effectively declared the end of its era as a traditional automaker. That chapter is closed. They are pivoting, fully unhedged, betting the entire farm into what they are calling physical AI.
The stakes here are they're astronomical. We're looking at a company that literally changed its mission statement on the call to amazing abundance.
I know.
That sounds less like a corporation and more like a sci-fi novel, but the actions back it up. They're killing off the cars that put them on the map, the flagship models.
And they're asking investors to stomach a capital expenditure hike that would make a sovereign nation sweat.
It was this fascinating mix of like high concept futurism and some very gritty, very expensive financial realities. The financials themselves were mixed, but the narrative...
The narrative was overwhelming.
Completely.
Okay, let's not bury the lead. Let's start with the hard numbers, the snapshot from Q4 2025, just to ground us before we get into the, sci-fi stuff. Here's the rapid fire.
Let's do it.
Revenue came in at $24.901 billion. That beat the consensus estimate of roughly $24.5 billion.
The top line is healthy.
Healthy enough. Non-GAAP EPS hit 50 cents, beating the street's expectation of 44 cents. Oh. But, and here's the friction, GAAP EPS was a miss.
A miss.
Came in at 24 cents against a consensus of 30.
Right, and for you listening who don't spend your lives in spreadsheets, we need to contextualize that GAAP miss immediately. Sometimes a miss is a sign of operational rot, costs are spiraling, demand is falling. This wasn't that.
Yeah.
This was dragged down primarily by non-operational items, specifically a Bitcoin impairment charge.
They're still holding that.
They are, and it bit them this quarter. Their holdings depreciated about 23%. You have to mark that down.
Wow.
Add to that some significant foreign exchange headwinds from intercompany borrowings, basically moving money around globally against a strong dollar, and you get that headline miss. But here's the key. If you strip out the crypto volatility and the currency noise, the operational engine actually ran hotter than expected.
Which brings us to the metric that actually matters for a manufacturing business, margins.
Yes.
Total gross margin hit 20.1%.
That is a huge psychological barrier.
It is. It's the first time they've broken that 20% ceiling in 2 years. Auto margins, excluding regulatory credits, improved to 17.9%.
And that recovery is so critical.
Right.
It signals that despite all the aggressive price cuts we saw in 23 and 24 to protect market share, they are finally finding efficiency again. They've squeezed the cost of goods sold down. They've optimized the supply chain. But, the real story is the market reaction.
It didn't tank.
No.
Okay.
The stock closed around, $431.46. And in after-hours trading, despite the GAAP miss and the terrifying spending guidance we're about to get into, it's holding gains, up anywhere from like 1.7 to 3%.
So the market is just looking past the earnings miss.
The market is entirely looking past it. In fact, I'd argue the market is ignoring the car business entirely. They are underwriting the long-term AI story. There is an AI premium holding this stock up right now.
Right.
If you valued Tesla on the fundamentals of a traditional auto OEM, selling metal boxes to people, the stock would be crushed. But investors aren't valuing a car company anymore. They're pricing an option on the future of labor.
Speaking of not a car company, let's unpack the biggest product shock at the call. This one actually hurt my heart a little bit. Elon Musk announced the discontinuation of the Model S and the Model X.
The end of an era. For real.
It really is. These are the flagships. The Model S is the car that forced the entire industry to take EVs seriously. It proved an electric car could be better than a gas car. And now, they're winding down production next quarter. Musk called it an honorable discharge.
It's sentimental, sure. But functionally, this is a ruthless efficiency move. You have to look at why they're doing it. They aren't killing them just because demand is soft.
Which it has been.
Though it has been softening for years compared to the Model 3 and Y. No, they're doing it for floor space.
Floor space in Fremont specifically.
Correct. The Fremont factory is landlocked. It's the Bay Area. They can't easily expand the footprint outwards. So to build the new thing, the old thing has to die.
And this is the clearest signal of that pivot.
It's the clearest signal we've seen. They are taking the assembly lines that built the cars that made Tesla famous, and they are literally ripping them out to convert that space for Optimus manufacturing.
The humanoid robot.
The robot. The goal Musk stated is to produce 1 million Optimus units per year from that specific line in Fremont.
1 million units.
1 million.
That scale is just... It's hard to wrap your head around. I mean, for context, most car factories struggle to put out 500,000 vehicles a year.
A robot is smaller than a car, obviously. Less sheet metal, no tires. But the complexity is arguably higher in terms of actuators, sensors, the density of the wiring harness. Musk mentioned we'll see an Optimus Gen 3 unveil in a few months, with significant production volume expected by the end of 2026.
Okay, that brings us to the trust issue. That is an incredibly aggressive timeline for a product that is currently, as they admitted, still essentially in R&D.
Right.
We've seen the prototypes folding laundry and walking around, but mass manufacturing 1 million of them in 12 months. That feels optimistic.
It's classic Musk's time.
Yeah.
But here's the difference. Usually when he makes these predictions, he's trying to raise money or hype the stock. This time, he's putting the company's cash where his mouth is. If you think killing the Model S is bold, wait until you look at the CapEx guidance.
Let's talk about that number. The guidance for 2026 capital expenditures CapEx is shocking.
It's the number that made every single analyst on the call just gasp. You could hear the silence on the line. Over $20 billion expected in 2026.
Put that in context for us.
For context, previous CapEx was hovering around $8.5, $9 billion. So they are more than doubling their spend in a single year. $20 billion is roughly the GDP of Iceland.
They're spending in Iceland.
They are spending in Iceland in 2026.
Where does $20 billion go? You can't just spend that on office chairs.
It's going everywhere.
Yeah.
They're funding 6 different major factory projects simultaneously. You have the Cybercab factory, the Sema factory, which is finally ramping, a new mega factory for energy storage, the Optimus line we just mentioned, the lithium refinery in Texas, and the LFP battery factory.
LFP being lithium iron phosphate.
Right, the cheaper, more durable battery chemistry that is crucial for the lower-cost vehicle and for their energy storage economics. But on top of the concrete and steel for factories, there is massive spend on AI compute clusters, buying GPUs, building data centers.
The CFO, Fabio Taneja, had a really interesting way of framing this. He didn't sound apologetic about the burn rate at all. He called it an infrastructure play.
That's the key phrase. He said they're starting a new book of the company. Look, they have about $44 billion in cash on hand. It's a fortress balance sheet. But $20 billion a year burns that fortress down in 2 years flat.
And Taneja explicitly mentioned they're open to debt financing for this, right?
He did, which is rare for Tesla recently. They've been paying down debt. But the logic is this. They are treating this almost like a utility or a telecom company building out a 5G network.
Okay.
You spend massive amounts of capital up front, billions and billions, to secure a monopoly on the infrastructure. In this case, the infrastructure isn't cell towers, it's physical labor and autonomous transport.
So they are betting the house.
They are betting the house, the garage, and taking out a second mortgage on the future. It's a complete all-in move.
Let's talk about what that future looks like then, specifically regarding the thing that is supposed to generate the cash to pay for all this. Autonomy. We got a major update on the Cybercab, the robotaxi.
Yeah.
Production starts in April 2026.
April. That's essentially tomorrow in automotive time. Musk emphasized the S-curve here. You start slow in April, work out the kinks, then grow exponentially. But the real news wasn't the future production date. It was the operational update from today. They confirmed that unsupervised paid rides are happening right now in Austin.
And just to clarify for everyone listening, because terms get thrown around so loosely in this industry, unsupervised means what exactly?
It means no human sitting in the driver's seat ready to grab the wheel. And as of yesterday, they confirmed no chase car following it to hit a kill switch.
Wow.
Just an empty car picking up a paying stranger and driving them to a destination. That is a massive technical and regulatory milestone.
It is. But there was also a subtle shift in the business model for full self-driving, FSD, that I think financial modelers really need to pay attention to.
This is huge. FSD is transitioning fully to a subscription-based model. They are moving away from that large upfront purchase price. That $12,000 or $15,000 lump sum is going away.
So why does that matter for the stock?
Well, in the short term, it actually hurts. When you sell a car with a $15,000 software package, That boosts your miles immediately.
You book the revenue.
You book that revenue. Moving to a subscription means you only get, what, $99 or $199 a month. It depresses margins initially, but long term, this builds recurring revenue. It completes the transition to a SaaS model, software as a service. It makes the revenue predictable, sticky, and ultimately much larger over the lifetime of the vehicle.
Which brings us to the brain behind the operation. We have to talk about the integration of XAI. There was a lot of chatter about conflicts of interest leading up to this call. Tesla is officially investing $2 billion into XAI.
Driven, according to management, by shareholder demand.
Is it, though? Or is it bailing out Elon's other venture?
I mean, that's the cynical view, and it's a valid question. But the strategic rationale they laid out was surprisingly coherent. They described Grok XAI's model as the orchestra conductor.
I loved that analogy.
It makes sense if you buy the premise. If you have a fleet of millions of robotaxis navigating a city, and eventually swarms of Optimus robots moving materials inside a factory, you need a high-level intelligence to manage that complexity.
Right.
Not just, how do I drive this car, but where should this whole fleet be positioned at 5 p.m. on a Friday? Grok isn't just a chatbot in this context. They see it as the logistical brain for fleet management.
Management also dropped a fascinating statistic to justify the Cybercab's form factor, which we know is a two-seater.
Yeah.
They noted that 90% of vehicle miles traveled are by one or two people.
Which just destroys the argument for dragging around a 5-seat, 2-ton SUV for every trip to the grocery store. The Cybercab is optimized for cost per mile efficiency based on that 90% use case. They're attacking the economics of transport, not just the method of driving. If they can get the cost per mile below a bus ticket, they win.
Okay, we need to shift gears to what I think was the most surprising and maybe even slightly terrifying segment of the call.
Yeah.
This is where the macro conversation got really real.
Oh, yeah.
Elon Musk apparently spends his Saturdays designing the AI-5 chip.
Because he's worried.
He sounded more than worried. He explicitly mentioned he is concerned about supply chain constraints capping their growth in 3 to 4 years, specifically memory chips.
And he dropped a statistic that I think caught a lot of people off guard. He explicitly mentioned there are 0 advanced memory fabs in the United States. We talk about onshoring constantly. But in terms of advanced memory, the stuff you need for AI inference is all in Asia, primarily Korea and Taiwan.
And this leads us to the Tesla Terra Fab.
The Terra Fab. This is the proposed solution. Tesla is planning to build its own domestic semiconductor fab that handles logic, memory, and packaging.
Okay, stop there. Do you realize how insane that sounds?
It is completely insane.
Apple doesn't build chips. NVIDIA doesn't build chips. They design them, and they send the blueprints to TSMC in Taiwan to actually bake them.
Right.
Semiconductor fabrication is notoriously the hardest, most capital-intensive manufacturing process on Earth, and Tesla thinks they can just do it.
Musk justified it with a quote from Andy Grove, the former CEO of Intel. "Only the paranoid survive." He views this as an existential hedge. He called it paranoia.
What's the specific fear? What is he paranoid about?
The fear is geopolitical. If China invades Taiwan, or if there's a naval blockade, or even just a massive earthquake in the Pacific, the supply of advanced chips just stops.
And if the chips stop?
If the chips stop, Optimus becomes a paperweight. The Cybercab fleet can't expand. Musk argues that the risk of not having the chips is greater than the risk of failing to build a fab.
So he's willing to burn billions on a process that might fail just to have an insurance policy.
Exactly.
Yeah.
He argues it's crazy not to build the fab. It's a level of vertical integration that goes beyond what any modern tech company attempts. Tesla wants to bake the cake, grow the wheat, and mill the flour.
Because they don't trust the bakery to be open in 2029.
Precisely. And this leads us to a fascinating point about their view of the competition.
Right, let's zoom out to that investor context.
Yeah.
If they're pivoting this hard and building their own chip factories, how does this position them against the rest of the automotive world? What about Ford, GM, BYD?
Well, according to Musk, there is no Western competition. He dismissed the legacy automakers entirely. He didn't even mention them as rivals. No. He admitted the only real competition for manufacturing and humanoid robots is China. He respects their speed and their AI capabilities. But Ford and GM, in his mind, they are fighting over scraps in a dying industry.
That's a brutal assessment.
It is, but look at the valuation. For you, the investor holding the stock, you have to change your valuation framework. You cannot value this company on a PE ratio of cars sold anymore. That math doesn't work.
Right.
Management is asking you to value them on the potential of universal high income. a phrase Musk used, and the GDP impact of millions of Optimus robots.
Universal high income. That implies that the robots create so much wealth that money becomes abundant.
It's a utopian pitch to sell a capital-intensive transition.
So the car company narrative is officially dead.
Buried. If you own TSLA today, you are owning a volatile AI infrastructure and robotics ETF wrapped in a single ticker. You are funding a massive science project that just happens to have a profitable car business attached to it to pay the bills.
All right, that brings us to our favorite segment of the show. We've digested the call, we see the paranoia, we see the spending. Now imagine you're a portfolio manager at a multi-strat hedge fund. You're walking into the investment committee meeting tomorrow morning. What is the wildest, highest alpha trade you pitch based on what we just heard?
Okay, here's the pitch. I call it the paranoia supply chain play.
I'm listening.
The premise is simple. Elon Musk is terrified.
Yeah.
He is terrified of running out of memory chips, and he's paranoid about a geopolitical supply chain collapse. He explicitly called out the lack of U.S. memory fabs.
Okay.
But we know building a fab is incredibly hard, so the trade isn't necessarily Tesla stock itself. It's long U.S. domestic semiconductor equipment and materials. Specifically, the companies that specialize in the equipment needed for memory fabrication.
Walk me through the logic. Why do they win?
It's a win-win scenario. Scenario A, Tesla actually tries to build this Terra Fab. To do that, they have to buy billions of dollars of equipment. They can't build the lithography machines or the etching tools. They have to buy them.
So they become a massive new customer.
A massive new buyer entering the market with $20 billion in CapEx to spend.
And scenario B, if they fail.
Scenario B. They realize building a fab is too hard. But the paranoia doesn't go away. So what do? They sign massive, strategic lockup deals with domestic partners to secure capacity. Musk even name-dropped Micron on the call. If Tesla writes a check to secure 50% of a domestic fab's output, that fab has to expand. Who do they buy equipment from?
The same suppliers.
The same suppliers.
So you are front-running the $20 billion CapEx spend before the purchase orders even hit the tape.
Exactly. It's a pick and shovel play on Elon's anxiety. You aren't betting on whether Optimus works. You aren't betting on whether the robotaxi crashes. You're just betting on the fact that Musk is going to spend billions trying to make sure he has the silicon to build them.
I like it. It's cynical, it's capital intensive, and it makes perfect sense based on the psychology of the CEO. But as always, we have to say it. This is plausible logic, but it is absolutely not financial advice.
Please.
Do your own diligence. We are just reading the tea leaves here.
Please do. Don't trade your rent money on a podcast theory.
So, to wrap this all up, Q4 2025. This was the moment. This was the moment Tesla stopped being a car manufacturer and started being a physical AI abundance machine.
They're betting the company. They're betting $20 billion in a single year on a future that doesn't exist yet. The CFO said it best. The new book has begun. Now we just have to see if they can actually write it without running out of ink or cash.
And we'll be here to read every page with you. Thanks for listening to this deep dive on Talk Tickers. Make sure you're subscribed for the next earnings season, because if this is any indication, things are only going to get crazier from here. We'll see you next time.